Good morning. It's September 3rd, Friday, 5:50 a.m. Welcome to episode 16. Good morning to you, Wowie.
Good morning, Mark.
And good morning, sir. And good morning to our listeners. I hope everyone had a great week so far. This is your host, Mark Yu.
And Wawi Santos.
Welcome to the Mark Yu and Wowie Show. A disclosure, this show is made for sharing information purposes only and not to be considered investment advice. We record once a week. I and Wawi are both physical therapists here in the USA with the same passion and interest in researching and investing our hard-earned money in the stock market. The show's goal is to share and learn from each other, answer questions, and to our co-workers in the medical field, thank you guys for your hard work. We are available in YouTube, Spotify, and podcasts. On our previous episode, we discussed the ongoing red hot real estate market and data pointing to possible continuation of it. So for those who have missed it, please feel free to go back and listen to it. So on today's episode, we have here a little bit of a gloomy title, Economic Slowdown. So we're going to tackle on first the Economic Surprise Index. So this is a Citigroup Economic Surprise Index that Citigroup does. It's a score that measures the degree to which economic data is beating or missing estimates. So according to this graph, it has fallen into a negative territory for the first time during the recovery from the pandemic-induced recession. So as of recent last week, it went down to negative 37 with a recovery period peak of just over 250. So that's quite a huge drop. It's now at negative 51.8 as of yesterday. So what can we derive from this? Well, for me, it's just, a recent change in economic surveys, because this is a survey, and according to a Barron's article that I just read, which kind of like explicitly explained what could be the reasons behind it. First of all, is the fight or flight engagement that the measurement is taking from their participants. For example, these are mostly emotional responses as a result of rising COVID variant cases, rise of inflation. As of 2 episodes ago, we were looking at slowdown in new vehicle sales. So some could be part of it that's been absorbed by this measurement. Also, the ongoing military conflicts, which began mid-August, last month, and some of which also can be derived from the economic policy changes that the Federal Reserve has been already discussing. So despite this, this is an article from Fox. S&P, Nasdaq hit record highs ahead of jobs data Friday. So for our listeners, today is the first Friday, September. So the government is due to report the recent jobs numbers. So initial job claims was actually reported yesterday, and it fell to the lowest since the lockdown in March of last year. So all of which pointing to good signs in terms of the jobs market, which is overall positive for the markets. So I saw a report here. They were actually counting the tallies of the all-time highs. But yeah, on the jobs report, also from Barron's, which was released yesterday, it says here it's already foreshadowing what's going to be happening if the U.S. actually delivered a great jobs report. Entitled, it says here, why a great jobs report would be bad news for the stock market. It says here, investors want to know that labor market is strong, but if Friday's payrolls report is too strong, it could be bad news for the stock market. So a result of 900,000 or more, this is in terms of jobs creation, could bring the unemployment rate, which is expected to fall to 5.2%, below 5%, says Tom Essay, founder of Sevens Report Research. A number viewed as too hot could prompt concerns that the Fed would reduce monthly bond purchases to 90 billion from a current pace of 120 billion in November, rather than Essay says, rather than current expectations for the Fed to lower purchases to reduce purchases in December or January. Stocks would likely drop, potentially sharply, Essay writes, with the S&P possibly dropping 1% or more. So it's all a matter of time framing it. According to Fed minutes or FOMC minutes that me and Wally have discussed at least an episode ago, the FOMC minutes, which records or keeps a data of what the Fed policy or the Fed governors were discussing, what they're going to do with the interest rates, revealed that they're thinking about possibly lowering it. Lowering the purchase down on December or early next year. So a good jobs report today would indicate that the Fed might take action sooner, maybe in November instead of December or early next year. But thinking about it, just a month ago, the Fed was actually even saying that it might reduce its bond purchase 2023 or 2024, Huawei, if I'm not mistaken. So it's been quite some changes. So some interest rates hike possibly coming up soon. So this is what I was referring to. The number of closing highs for this year, we're at 53. So we've reached 53 all-time highs for the S&P 500, which is not far away. Quite some ways from other all-time records. It's 1, 2, 3, 4, 5. It's the sixth highest number of closing highs in history. Whereas the number one, for our listeners who are interested to know, we actually reached 77 new all-time highs in 1995. This is during the year of great late 90s. This is on its course to the US bubble or the tech bubble during the 1998-1999 era. And the second one was 2017, which we logged 62 new all-time highs. This is regarding the Icarus trade. So we looked that up earlier. It's something to do with Europe with their policy changes. And then the third one would be in 1964, which also record 62 new all-time highs, a secular peak, it's said here, in 1965. And we're about 6 new closing highs difference now to the 1928. So for our listeners who haven't known, so 1928 was the year where everything was perking up, everything is way up there, and then all of a sudden in 1929 the bubble burst, and that's when the great crash of October, the Black Friday, I believe, occurred. So jumping on to the next topic. So jobless claims total 340,000, lowest level since the pandemic. Next segment. Here is a interesting chart which was made by the Wall Street Journal. It just compares that people or the states who have still maintained their enhanced benefits compared to those who have ended their enhanced benefits. So it just looks like it's about the same for those who have removed their benefits. States that ended enhanced benefit, it says here, early have so far seen similar job growth as states that continued offering pandemic-related extra aid, according to the Wall Street Journal. So not much changes still, in terms of like having the job aids removed or federal unemployment insurance. So here's a chart for our listeners. It says here Apple and Microsoft, Alphabet and Amazon, also known as the big tech. So Apple notched another all-time high. Their valuation is now $2.5 trillion. Microsoft, it's about 2 trillion. Google or Alphabet, its parent company, is closely reaching the 2 trillion mark. Amazon recently um, have a life of its own, starting to bounce back up. It has been actually sleeping since the start of the year, going down a little bit, but now it's bouncing back up. It's closely reaching $1.8 trillion as well, reaching closely behind Google. So on our next video here, a video clip that was just yesterday, it's regarding the thoughts of a possible pullback this month. So this video is entitled, "Is an economic slowdown already priced into the markets?" It's a CNBC interview with Tom Lee. So we're just going to roll the clip.
Economic data for August coming in weak, with consumer confidence and ADP employment among the reads missing expectations. Let's bring in Tom Lee from Fundstrat Global Advisors. Tom, great to see you as always. I mean, to what extent is this bit of a slowdown for this quarter already priced into the market, do you feel like?
I think the slowdown that you're citing is positive for markets because, as you know, over the last 8 weeks, I think markets were really worried about two things. You know, one was the trajectory of the Delta variant and how that could lead to really adverse economic outcomes. And the second was the Fed was really leading towards an early taper. And I think the soft readings that we're getting in the past couple of weeks is pushing the Fed off. And I think the Delta variant concerns have actually made the Fed dovish too. So as you know, pre-pandemic, the adage was always good, weak data is good news because it made the Fed dovish. And I think that's where we are today, that if we get soft side readings, it's actually bullish for stocks.
And you think particularly bullish in the short term going into later this month?
Yeah. We think we're in an environment where we're going to see everything rally into the end of the month. I know a lot of people think September is seasonally weak, but positioning was already quite bearish into the start of September, whether you're looking at the VIX, which spiked in August, or the rapid liquidations by retail investors over the past few weeks. Investors were bracing for sort of a weak final few quarters of the year. And because of that positioning and the Fed turning dovish, I think we're in a sort of reversal of that. And I think investors will get quite optimistic into the end of the month. And that's really the fuel for the rally.
A little bit more, because if softer readings might actually be good in terms of Fed policy, I mean, it looks like you favor energy and materials right now. Why?
They're really the tip of the spear in the epicenter trade. Oil got clobbered starting in June as we started to see the Delta variant surge. I mean, oil went from 77 to 62, and now oil's decisively back above 70. Wall Street firms like Goldman think we could even get to $80. Well, there's going to be a really big tracking catch up with energy stocks because energy stocks have underperformed this move in oil. So I think energy is a good risk reward into year end. And then materials that really, I think, benefits from the supply chain tightness. And the third group we like is FANG. Part of it is the everything rally, but also as investors come back into equities, I think they're going to go buy things that they're comfortable with, which tends to be FANG.
So Tom, ultimately, is your argument for reasons why you're bullish that we're only 1 year into the start of a totally new cycle? Does that still apply even when all of the stimulus is removed a year or so from now, or maybe a little further? Is it reliant on stimulus, or is it not, because it's a long new cycle ahead?
I mean, the future's uncertain, Wilfred. So I don't know what 2022 looks like, but it would be rare for a stock market to peak only 12 months into a new business cycle. As your guest earlier, we're talking about like Stephanie Link, there's a CapEx cycle coming because companies were hesitant over the past year because of COVID. There's a lot of capital stock that's been depleted. So not only do we have an inventory cycle coming and a reshoring of capital assets in America, but if there's infrastructure plus a capital spending cycle, these are all supports for markets. And it's not necessarily dependent on the Fed, but I think it's gonna be tough for markets when the Fed begins to taper. So I'm not saying the markets can look through the Fed tapering in the short term.
Whew.
Economic data for August.
So, what do you think about that interview, Kuya?
I'm just like curious when the Fed is actually going to taper. I know the question is how soon they will do that.
Mm-hmm.
I think they're testing the waters because there's some news as of yesterday
Mm-hmm.
that is saying that there's a possible taper by November.
Mm-hmm. Yes.
So the question really is, is the market still efficient?
Right.
Are the prices reflecting the actual value of the stocks that are in the market?
Yes.
So those are, and I think, still we're looking at high prices, but you still find value I think in some small financial firms.
Mm-hmm.
You just got to look around and you'll see some, some efficient evidence of efficient market out there. But for the most part, the FANGs are overvalued.
No question.
Right?
Well, they're in the trillions right now, as we've just pointed out in a few slides ago.
So I don't know why Tom is saying that people will move into the FANGs.
Right. So there are a couple of things that I'd like to point out there that you just have commented on. First thing is the positioning of the investors. Why does he recommend investing in a FANG? So he has like three things that he's pointing into as to where he's investing his money or his fund's money. One is energy and oil. Second is materials. These are reopening plays. And then he also put in FANG stocks. So this is like the lockdown stocks. So he's actually pointing into a broad investment like strategy. It's not like being stuck in reopening, but he also wants the investor to be exposed into the, already tried and proven big tech. I think this is the case to some analysts. I saw here a recent quote by Ryan Detrick, chief market strategist at LPL Financial. He said, in terms of positioning, tactical investors should tilt portfolios in favor of stocks over bonds. So, and after that, he said, this certainly does not mean that an exogenous shock could not cause stocks to correct. However, when looking at the recent pace of earnings, the policy environment, and market history, we fail to see a compelling bear case against equities. So I think overall, if you're going to invest in the stock market, you should still be able to allocate some exposure to the big tech, because I think so far they are the tried and proven stocks to get into in terms of being exposed to the stock market. Also, I'd like to say it's packed. That interview with Tom Lee, it's quite informative, albeit short. He said on the first part of the interview that weak data, which we are currently pointing at, the economic surprise index that Citigroup does, can still provide a bull case for the market where it could throw Fed. This is like psychology. Like if you have weak data, then Federal Reserve might then hesitate or even move the interest rate sooner. And also pointing it out to a Barron's article that we just discussed some slides ago. So this is quite interesting. So at this episode, actually, I'm trying to like put out a negative sentiment out there, but it's still hard because of these information that's coming through. So definitely it's a negative, the economic surprise index, in terms of missing estimates. It's definitely showing up. We're now at negative territory, which is quite, for me, it's a little bit of troublesome indication. And another one that he pointed out, Tom Lee said, the positioning of the investors. Retail investors have been actually selling prior to this month because they are already expecting that September seasonally is a bad month. So this is again running against the long time saying that time in the market is better than timing the market. So actually this could, according to him, could eventually still support the overall bullish situation of the market. So that's quite interesting. So this is an oil price chart. So not so long ago, if back in our messenger group, we were discussing the negative, how much? $40 per barrel oil last year, when during lockdown, and ships getting stranded overseas and not being able to deliver oil, all those negative stuff that's happening. From negative $40, now we're at 70, and he's thinking that it could even go reach 80. So it's quite an interesting.
Yeah, that's a good sign.
Yes, it's like.
Do you by any chance know how much OPEC is producing? Did they increase production?
Well, the thing is, I think OPEC actually came out with a press release yesterday that they aren't trying to slow down any of their production. They're still gonna pump out oil.
Okay.
Now it's like OPEC plus Russia, I think. OPEC plus in terms of doing their production stuff in oil. So they are not definitely slowing down. They're still pumping oil, which is ultimately, more production, more supply should entail lower price. But at this point in time, there is still demand in terms of, because there's a bounce. Like as of August 16, oil per barrel was at $62. It fell from $70, but now as of August 30, we're back at 70. So I think Tom Lee for one is thinking about a bounce back still of oil going higher as demand increases. So this is the one week performance of different sectors in the stock market for the past week. Real estate, quite impressive. It's up almost 4.6%. Energy, as Tom Lee pointed out, is getting stronger. And the bottom performers are financial. So take a closer look at this while we look. At the start of the year, the first quarter, it was always financials and energy that's grouped together as reopening plays. But for this week, quite a divergence. Energy is rallying, the oil is rallying, while financials are definitely laggards or steady. Despite the ongoing back and forth possible interest rate hike, because one industry that will benefit for sure for interest rate hikes is financials. They earn more money with higher interest in loans. So for the past month, it's good to look at in terms of relative performance. Real estate is still booming. A long time ago, a month ago, I think when we first started the podcast, while real estate is nowhere to be found. It's always like in a neutral position, not really outperforming the market or whatnot. But real estate for the past month is booming. It's definitely reflecting what's going on now in the real world, like where you're trying to buy and as you've personally experienced, and I personally experienced, because I've been looking at the houses too. So you want to share an experience of yours, Wawi, in terms of like looking and settling into a new house to our listeners? So what happened to your latest venture for the past week?
So last weekend, we went out to look for homes, and we picked out a couple of homes ranging, sub 200K price, 3-bedroom, 2-bathroom.
Oh, that's cool. Yeah.
So we made our offer, and this is with warning from our agent saying that the market is not normal right now and it's a bidding war.
Right.
So we made our bid, I'm thinking maybe 5, a little bit like 5% above the existing price. And we know that it's a 50-50 chance.
Right.
So within 24 hours, we were told that we didn't get that they did not consider our offer. We were outbid by one, and then one
just in 24 hours.
Yes, and then one got the house for by paying, cash up front.
Cash. Oh my gosh. 190, $200,000 cash.
Yeah, so it's
wow.
It's listed as 184. This one particular house that we saw that's in a very good neighborhood, built in 97, 3-bedroom, 2-bath, and so it's fairly new with minor cosmetic repairs needed.
Right.
I think somebody paid cash for it, maybe close to 200K, if not 200K.
Wow. So this is in East Texas. That's crazy. People are still bidding.
What's good about Tyler is you could still find homes sub 300K here, and in good neighborhoods.
Right.
And there's still a lot of open land. I think prices are, slowly rising when it comes to acreage. But you could still find some bargains here, but you have to outbid the others.
I know, yeah. So it's still a kind of a play in supply and demand. So despite having a lot of land,
yes,
definitely there are situations where there's residential built and commercial land. So more likely, that's why people are still bidding. There are still a lot of demand in market. This is in Tyler, Texas. For our listeners who don't know or out of state, this is like in East Texas, about, I would say, a couple of hours or 3 hours east of Dallas, right, Wabi?
Correct.
Yes. So here's a tweet that I saw is from let me see, Rick Palacios. He's a director of research in real estate consulting. I think I got through this tweet a couple of days ago. It was tweeted on August 20, but he did a survey of 6,000 plus real estate agents across the country. And the top themes, he said, from their first ever resale agent survey, he said, number one is buyer fatigue with rumblings of remorse. Number two, bidding wars are a bit less bonkers. So there's a slowdown happening in the survey for sure, or reflected in the survey. It says number three, cash is king and ton of investors. So there are still a lot of investors with cash on the sides, definitely. In inventory gridlock, or it means a lot less inventory. So let's look. He did some specific states. So we're gonna go through Texas. Let's find Texas. So it says here, Houston agent. This is a quotation from a Houston agent. The Houston agent said, some of my clients are waiting to buy due to the high cost / bidding war. They feel that any house they purchase will be upside down in equity due to the bidding wars that are going on. Hey, so this is something to keep an eye on now, Wawi.
Yeah, so all serious buyers only. And
yes.
You'll still spend some money because you're gonna put down some earnest money there, around $200 to show that you're a serious buyer.
Right. Oh, speaking about earnest money, Wawi. So I myself, for the past week, actually put in an offer and it got accepted. It's for a multifamily. I deposited earnest money. Speaking of earnest money, I deposited about $3,000 earnest money, showing that my intent is clear to acquire the property. But after running the inspection, you have to pay the inspection and running the numbers again over and over, it just didn't make sense. So what's good about earnest money for those our investors, listeners who haven't invested in real estate, earnest money, you can actually take it back within that allotted time frame without, the seller taking it away because you pulled back your offer, you canceled the transaction. So one good thing about this is I'm still working with a really good real estate agent. And she told me you could still pull the money back. You can still take it back if you decided not to pursue the purchase because of the numbers. So I was able to get the money back. So $3,000 is back in my bank account. At least it's depositing back.
That's
So
good.
one scary moment there is like, if you have, always make sure to know what your optional days are when you're submitting an offer. Always make sure, because if for me it was 15 days and I offered to buy the property to about 10 days ago. So I'm still like 5 days short, 5 days more in terms of my option day period where I could pull back the money. Whereas after the 15 days option period, you can never, it's gonna be difficult to get that earnest money back. So yeah. So for going back to the stock market, performance year to date, number one performer, communication services, which includes, of course, the Googles of the world. Energy, oil, year to date is outperforming for sure. Real estate, actually, in this chart, year to date, all industries are up.
Yes.
To cut it short, the stock market is really buoyant at this point in time. Now, to a more important part, the sentiments. If as Wawi was questioning earlier, is the market efficient? So this is one way of challenging that thought. Looking at the sentiments, the different sentiments in the market. So as we all know, we always look at weekly, the American Association of Individual Investors, which was ask a simple question to their participants: what direction do members feel the stock market will be in the next 6 months? So now we are encroaching more of a bullish sentiment. So all this time for the past month, we have just been hovering near the historical averages. But now we have passed through the 40% marker for the bullish sentiment. We're now at 43.4%, which I believe it's a high for this couple of months situation. So
yeah, I agree. But this probably reflects, the recent statement by Jay Powell. So it's a short-term sentiment, in my opinion.
Yes.
We'll see. Next week, we're having a good rally in the market right now after
definitely
the Fed chairman spoke and reassured the market. This is reflecting that recent statement. By next week, we may see a different tone.
Yes.
But when you're questioning the efficiency of the market, we should start thinking, okay, is the market still rational? So the movement of money out of the market, some of that moving out of the market, is, I think, it's a rational reaction. So I think the market is still rational.
Right.
We are not in a panic mode, and
no panic in sight. Bullish. And Tom Lee
still bullish.
And Tom Lee just said for the past couple of weeks in the interview earlier that retail investors are actually selling, trying to position on cash on this month, making it a better support overall for the markets. So now we're at 43.4% as of September 1st compared to 39.6%. So for the past couple of months, we've never breached 40%. So this is an interesting find now. Bearish, they're still the same, 33%. The bearish continue to be bearish. So this is the volatility index. For the past 5 days, we are down 10%. So what coincides with the bullish market is a decline in volatility or up and down in the market. Overall, we're turning up. This is what just the volatility shows. For the past month, looks like it's about the same. No, it's gone down from 18 last month. We're now at 16. Relatively awkwardly similar to the past week performance. And fear and greed, here we go. So just a week ago, we're still at fear at 39. So now people are getting a little bit greedy at 56.
That's a good sign of the rationality I'm talking about. Because investors are still trying to profit out of the market. That's part of the rationality. Okay, they're still wanting to make sure that they hedge properly and pick the right holdings.
Right.
So this is a good sign.
Mm-hmm. Steadily increasing greed, but it's not like we're still ways to go to achieve like extreme greed. So there's another chart. So just a few months ago, we were hovering at really like fear or even close to extreme fear, but now we're at about greed, ways to go to extreme greed, but a little above neutral now. So these are the flows by Bank of America, by client, sector, and size. So it said here, financials was the only sector to see inflows in terms of the past week from August 23rd to August 27th. Aside from that, people are piling on ETFs. So quite an interesting find. The rest of the industries from utilities, materials, industrials, energy even, the top performer for the past week, or I mean, real estate was the top. Even real estate, tech experienced outflows. So according to Tom Lee, people were selling, trying to position against a seasonally weak month of September. But looks like it's gonna provide the support later on once these people put their money back to work. Because there's no, for me, there would be coming to a point pretty soon that that what they call TINA, there is no alternative, and they have to put their money back to work in this U.S. stock market, which is the best stock market in the world, in my opinion. So this is a market economics data compiled by JP Morgan. It's called JP Morgan Global Manufacturing PMI. So the JP PMI is a composite produced by JP Morgan and IHS Markit. So it's a quite a graph where it shows here it just a couple weeks ago it slowed down up here from over 50, let's see, 55.5 in June. It posted 55.4 in July. So like a tick below, it's not that obvious that global manufacturing is slowing down, but definitely it could be a sign that, there'll be a little bit of slowdown ahead of time. So this is a global manufacturing sector. It said here on this review, the global manufacturing sector expanded at a robust clip at the start of the third quarter. However, rates of increase in output and new orders eased again. As record supply chain constraints stymied growth and drove up input prices. The challenging operating environment hit confidence, which dipped to a 9-month low. So we're going to look at another chart. This is the JP Morgan Global Manufacturing PMI, another view. So in August, we definitely slowed down, which is not that troubling. We're still above 50. If we go dip below 50, that will be contraction mode. So definitely some slowdown in manufacturing globally. Here is a very timely article by Reuters, published September 1st. It said here, global economy factories hit by pandemic-related supply disruptions. So this is not just stationary in terms of like one country being hit, but it's hit most of the like very productive nations, which we already know. China is number one in terms of production. Japan is, in addition to that, Japan and South Korea saw their activity expansion slow as well. Whereas the consumer economy, Europe or Eurozone, hurt as well because of the COVID variant changes. So it shows here in this article, it outlines specifically Canada's economy as well. So in Britain, where factories also face disruptions, this is in Britain, Europe, output grew in August at the weakest rate for 6 months. So this is in Britain, weakest rate at 6 months. United States likely suffered a similar slowdown. So there's definitely a slowdown in terms of factory manufacturing output. Canada's economy unexpectedly shrank last quarter, and in July, hurt by decreasing in manufacturing, construction, and retail trade. Australia reported slower growth. So this is like in the first world countries. Also as well in China. China's manufacturing PMI fell to 49.2 in August. So this is quite troubling because China is like the number one in terms of global manufacturing output. It is at 28.7% of global manufacturing output, number one in the world. And the second one is the United States at 17%. So China manufacturing output indicated a slowdown, a contraction actually. So breaching the 50 mark, separating growth from contraction. So according to a commentary from Jeffrey Haley, an expert in Rwanda, the elephant in the room for the long North Asia, short Asian view is China. This morning, the Caixin Manufacturing PMI, or purchase manufacturing, followed yesterday's official numbers south, falling under 50. That rounds out a grim week for China's PMI as COVID lockdowns and the same supply chain challenges the rest of the world is experiencing erode economic performance. So something to keep an eye on, Kuya Wawi. Looks like we're definitely experiencing a slowdown globally, but the stock market couldn't care less. We're still we're still up there, I guess. All-time highs. And this is the consumer confidence that we talked about an episode ago, which actually it's been dipping too. It's been going down. So something definitely to keep an eye on. So on our next segment, this is just a clip, red hot, fresh from the oven, published yesterday, from Bloomberg, garnering 3,800 views. It's regarding a hedge fund. To be specific, it's Ray Dalio's hedge fund. It's one of the biggest, I mean, if not, it's the largest hedge fund in the world. The way that the hedge fund makes money is to get a lot of funds from big pension funds. And it looks like it's going to be encountering some issues moving forward. Let's play this clip.
A California county's $21 billion pension is considering whether to drop Ray Dalio's hedge fund. Bridgewater's Pure Alpha Fund underperformed for most of the past 16 years. Joining us now with more Bloomberg Schlein Bassik. This is really great reporting by Bloomberg. Underperformance for 16 years. Walk us through the premise of the story.
Yeah, Kathy Burton and Melissa Karsh have really been on this for a while because this has been since 2005. This is not just 1 year of underperformance. This is annualized underperformance over a span of time. Now, this pension, Bridgewater manages $175 million for this pension. So it's not an enormous pension. It's not one of the biggest, but the question remains is if they are considering this, are other pensions also considering this? And what does this mean for other macro managers which have faced similar troubles over the past couple of years?
How quickly would that happen? Say this pension fund decided that was the way it was going to go. How quickly could this all unwind?
Fairly quickly, right? Obviously, it takes some money to get money back from time to get money back from hedge funds. These are illiquid products. If you are a big pension fund client, hedge funds, other asset managers do everything they can to keep you, to make you happy, to improve performance, to maybe make concessions on fees. There's a lot of things you can do to keep a client around, especially at a fund at the scale of Bridgewater, one of the most famous, biggest in the world. But again, it's a very competitive time for hedge funds, and you're at a time where people are very worried about the markets. They are looking for yields everywhere they can get it. They are very focused on fees, and this is not a bad time for hedge funds overall, by the way, guys. It's a time where they are raising money. So that idea that macro hedge funds as an asset class are up 6.8% this year, but equity hedge funds are up almost 12% this year, makes you wonder where investors will choose where to put the money, because they're thinking long term, but the yearly performance is tilting favor away from a lot of macro funds.
Oh, what do you think about that, Wabi?
Time for hedge funds, and you're at a time where people are
looks like big money is pulling out of hedge funds. Smart money, that's what they call them. Oh, Wabi, audio.
Oh, sorry. Yes, I got it muted. Anyway, it looks like sad state of affairs. People are, I guess, deciding that they're gonna drive on their own. They're gonna control and actively manage their own investments.
Right. Well, according to that reporter, she said that actually this year is not a bad year for hedge funds. Well, she outlined here if you invested with the hedge funds, for those who are, qualified to invest in a hedge funds because they have a certain criteria, you should have a certain amount of assets, but still, equity or stock market investing with the hedge funds led to 11.6% this year return. It still markedly underperforms the market because year to date S&P is almost like 20%. And to consider that the hedge funds will take 20% of whatever gains or the amount of assets in that portfolio is going to pull your portfolio down to a underperforming asset, or you wouldn't have been able to capture the whole alpha of the return of the stock market if you've invested. So probably that's why this pension fund is pulling out their money from the Ray Dalio's.
Yeah, and I think some of that money may be going into like market makers because of there's a lot of mergers and acquisitions, and a lot of companies preparing for IPOs. So those market makers that are supporting these companies going into IPO and mergers and acquisitions are probably going to be the drivers of gains this year, if not until next year.
Yes, and usually hedge funds have their own rules where they're going to invest the money. So some of these, this is a pension fund that's trying to move their money maybe more conservatively. Probably it's all because of the poor performance, as earlier on that was said, like underperforming the stock market for the last 17 years. So that's quite a blow. 17 years you're underperforming the stock market. So whereas, you should have been outperforming because people are paying you money to outperform it. But regardless, so going on to our probably last segment of today's episode, this guy said, this is a Bloomberg article which kind of raised eyebrows all over Wall Street. It's entitled, "Billionaire-backed stock picker says bubble talk is for boomers." So underlining it said, "Blue Whale Capital U doesn't see repeat of .com crash. His top holdings include, guess what? Google, Microsoft, and Adobe." According to him, according to this article, it said, as Stephen Yu's main fund nears £1 billion or $1.4 billion after doubling its money in 4 years. So 4 years ago, it was £500 million. The likes of Michael Burry, the Big Short, aka Big Short, are signaling that investors should beware of frothiness in parts of the tech sector. That doesn't faze the 43-year-old Yu, who prefers the reliability of Google over Netflix or brands that are now so ingrained in the minds of millennials that .com crash of 2 decades ago is a mere blip in their browsing history. He said, people who are, say, maybe 10 years older than me, so in their 50s, they probably were in the market at the time and they got burnt. You said in an interview at his Mayfair office, they still think that tech today is the same thing as what happened then and is going to go bust. Google is not going to go bust. Microsoft is not going to go bust. I mean, if the shares go down in any shape or form, you buy it. It's just like there is no bubble, he said. I can go on and go on this article, but looks like this guy is definitely a bullish camp of the market.
Well, I guess at that age range, I fall into that boomer age range. But as a recent active investor, so I guess I fall into the younger. I like to think of myself as a millennial investor rather than a boomer investor. But he has a point there. This is, if the market crash, I'm kind of on his side as far as the market crashing. This is very different, in my opinion, compared to the .com. Why? Because the signals are still strong. The economy is still have strong signals.
Right.
The only problem is the supply chain. The supply chain is not yet normal. The market is rational. the market is, still trying to be efficient. The supply chain is the issue, and trying to control inflation. I think OPEC is doing the same thing. I just looked at what OPEC is doing, and they're saying that they're gonna slowly, up their production.
They're still
and I
going to
think that's
produce.
oh yeah, they will produce, but slowly, and I think that's good. You're not gonna shock the market by increasing supply
Any price
heavily.
shocks, yeah.
Mm-hmm.
Well, according to this guy, he's still optimistic of the market, definitely in the bullish camp, definitely echoing what Tom Lee earlier on said. They're looking forward to more probably higher stock prices in the near term at least, and they don't even bother criticizing what the big tech. Oh, Tom Lee actually said that's his third bet or third industry that he wants to put money on, which is the FANG stocks. For those of our listeners who still don't know those stocks, those are Facebook, Apple, Netflix, and Google. So overall, these companies as we've reviewed more than 4 episodes ago, these companies are in this rock solid balance sheet, so they can handle whatever economic throws into them. Albeit already the global manufacturing is taking a hit right now. It's still not reflected in the stock market. I'm not saying that the stock market will crash or anything like that, but there are some signs of slowdown for sure, obvious slowdown. So before we end, we're just going to take a closer look at UPS and FedEx, as we have promised on a last episode. These are a couple of big companies, logistic companies, that kind of like shadows what's going on with the economy. So the stock price of FedEx is actually off of 17%. It's down 17% from its 1-year high, as you can see in this chart. It's from $316 just back on June. Now it's around $267 or 17% lower. Its current price to earnings ratio is 15 times earnings. Whereas, I'm sorry, that's FedEx. I'm saying FedEx. FedEx from $300 something down to $267 is down 17%. And it's now trading at 15 times earnings, which is quite a discount compared to the overall market, which is hovering at 26 times earnings. UPS, on the other hand, was ranging as high as almost $220 a share back in May. Now it's $198 a share, or down about 10% from its 1-year high. It's trading quite a good premium. It's trading at 29 times earnings. So UPS is more expensive in terms of earnings ratio compared to FedEx. So we're going to just take a closer look at their numbers, how they are doing in the past quarters. So this is the income statement that me and Wawi take a closer look at for the recent quarter. Because, of all economies is going tech or going online right now, people are definitely purchasing online, and deliveries are being, put to work, or increased deliveries has been showing up or reflective in their statements. So as of the June quarter, let me make sure, this is UPS. They registered 23.4 billion in sales. That's 3 billion more compared to last year's number. And their income, net income is 2.7 billion compared to 1.8 billion a year ago. So it's about 900 million. So UPS is actually more profitable at this point in time and definitely made more business as of the June quarter. So despite the share price going down a little bit as of recent, they've grown their numbers. Let's take a closer look at FedEx. So do you have any of these two in your portfolio, Wawi? FedEx or UPS?
No, I do not have FedEx or UPS.
The thing about FedEx is, I believe I have, a long time ago, I had FedEx in my portfolio at $121 a share. And that was during the lockdown. And it went up to 150, I think. And I saw, this is one of my mistakes. I track what insiders are doing. And I saw the chairman, I believe, selling a bunch of FedEx shares at one point at 160 or 170. So I joined him. I dumped all my FedEx shares, thinking that he knows better. But no way, it just skyrocketed way up there. But yeah, so UPS cash at this point in time, they have a total cash of about $8 billion, quite a good amount. And they have a total debt of 26.8 billion. So they have a bunch of debt. Minus cash, they still have $18.7 billion in debt. FedEx, meanwhile, let's take a look at FedEx as of their June quarter.
FedEx pays like a 1.13% dividend yield compared to 2% for UPS.
Really? Okay.
So UPS is paying more per share.
Right. So even at trading at 28 times earnings, which is a lot expensive than FedEx, which is 15 times, UPS pays a little bit more in dividends. Quite interesting. So FedEx reported in their May quarter a revenue of 22.6 billion compared to last year's quarter of 17.4 billion. So that's quite a huge jump for FedEx. More deliveries.
That's a good sign.
And their profits. Profits is interesting. They registered $1.9 billion in profits compared to negative or losses of 300 million last year. So FedEx has definitely turned its corner. Is selling for cheap right now, which is interesting. Well, let's take a look at their balance sheet, if it makes sense, because UPS has about 18 billion in debt outstanding. If they decide to put all their cash paying all their debts down, they'll still have 18 billion in total debt. FedEx, on the other hand, has about 7 billion in cash, and their total debt is $36 billion, 36.5. So they will still have about 29.4 billion remaining in debt if they decide to put their money to work. So that's quite a big difference in terms of balance sheet. Maybe that's why the market is kind of like discounting it shares a little bit. 15 times earnings. If I were to choose from which am I going to pick, I'll pick FedEx because of their valuation despite their extraneous or a lot of debt in their balance sheet, just because the brand name and all that, growing their revenue much more compared to UPS. So I guess we're gonna play the music. I guess that does it. Before we end, do you have anything to Wawi, our quote of the week, Kuya Wawi, for this week.
All right, so from some Buddhist teachings, never be controlled by three things. Number 1, your past. Number 2, money. Number 3, people. Okay, so just stay rational, stay efficient, and don't be swayed. Right. Be logical, weigh things, look at the market. Okay. The history is a good thing to pattern the trend, but do not make your conclusions just based on the past.
Right. So history, that kind of reminds me of a quote as well. So history doesn't repeat really itself, but sort of rhymes.
Yes, there you go. Right.
But yeah, don't be controlled of past, money, and people. Interesting quote.
There's a lot of changes. This is a different ball game, in my opinion.
Right. Well, I guess, Wawi, thank you so much for coming on today's episode.
Thank you, Mark.
Thank you, sir. And listeners, that does it for this episode of Mark Yu and Wawi Show. Send your questions, or if you just want to say hi, send us an email at markyuwawishow@gmail.com or tweet me at markyu_dpt. Remember, build that emergency savings and invest the rest for an abundant retirement. This is Mark Yu signing out.
And this is Wawi Santos. And for those cryptocurrency fans out there, Cardano is going up.
All right. Congratulations, guys. You guys have a good weekend.